Let's start. My name is Natalia. I'm a head of sales at Advanced Markets and Vortex. So just to give you, a brief introduction about the company, Advanced Markets is an authentic prime of prime. We have institutional ownership and secure data centers around the globe. So here are some of the banking partners that we work with, just for your reference. As I mentioned, our counterpart, our prime broker is UBS, and in fact, we've recently added Standard Chartered as a secondary PB. So here's the agenda, what we'll cover. We'll go through the hedge fund industry overview, we'll talk about the hedge fund performance, some industry challenges, and we'll cover the basics of starting FX hedge fund with some basic cost outline. So what is a hedge fund? A hedge fund is it can be defined as an actively managed pool of investment that is offered to a limited number of investors, and performance is measured in absolute return units. So here are some of the key things that you should remember about the hedge fund. Generally, hedge funds are more loosely regulated than let's say mutual funds or FX brokerages. The reason being is that hedge funds take only institutional professional investors. So it is understood that you as investor understand the risks that you are taking by investing in such a vehicle. There is, of course, an aura of secrecy associated with the hedge funds, because you probably hear a lot about Renaissance and Citadel and XTX and about the quantitative stuff that they do. They hire hundreds of PhDs in mathematics and physics, and they try to find inefficiencies in the markets. And of course, all their strategies some were hosted somewhere in the black box, and there's a great deal of secrecy associated with the trade and strategy of the hedge funds. The difference between the hedge fund and the mutual fund, for example, is that, of course, mutual fund takes retail investors where a hedge fund doesn't. It typically works with accredited investors, and each country defines it differently. In the US, accredited investor is defined as someone who has an income of $250,000 a year and has assets over $1 million. But it varies depending on jurisdictions that you go to. There's also performance fees that are pretty hefty. Unlike the mutual funds, hedge fund managers typically get compensated about 10 times more than the mutual fund manager. And there is this golden rule of 220, 2% management fee and 20% performance fee, which has been established since the beginning of the hedge fund industry. That was started by Alfred Jones in 1940s, and there's little change occurred to the performance fees. Of course, under the pressure of market conditions and investors, it has come down somewhat, but it still kind of remains in that 220 breakdown. And of course, the leverage. So hedge funds are famous for leveraging the investment, and that's how they're able to achieve the returns. So let's talk about the industry size. The hedge fund industry is estimated to be at $3 trillion in assets under management globally. Again, it encompasses all the hedge funds around the globe. So based on the information that I was able to obtain from Bank of International Settlement, TAS database, and some others, I was able to kind of work down from this $3 trillion to how much is actually managed in currencies, and not just in currencies, because most of the hedge funds, of course, deploy currencies for hedging purposes, because they invest in different equities all around the world, in Asia versus Australia and the US. And this is actually the number that is estimated to be $43 billion in assets under management in the currency hedge funds, meaning the hedge funds that have active currency strategy that they deployed. This number has come down significantly after the central banks started controlling the interest rate, and in 2013, for example, one of the largest currency funds, FX Solutions, or FX Concepts, managed by John Taylor, went out of business because they were not able to adapt to the new reality, of the macroeconomics, the controlled interest rates and global monetary policy. And so since then, there's been a seismic slump in the number, in the assets under management deployed into the currency strategies. So this is a guesstimate of $43 billion. Again, because of the secrecy and unwillingness of hedge fund managers to disclose their records, there's several databases that kind of track the performance and track the currency hedge funds, but most of the hedge funds are small, and so you don't have everyone reporting into Barclays Hedge Index or Eureka Hedge or other independent providers that try to assess the performance of the hedge fund. So this is just some of the key numbers about the hedge funds, and as I already told you, most of the hedge funds are small and they don't report their performance anywhere. There's estimated to be about 15,000 funds globally, of which only 4% manage more than 500 million, and those are the household names. You probably all heard about them. However, 69% has an AUM less than $50 million. The common investment is $250,000. It is also worth to note that when you do make an investment in a hedge fund, there's usually a lockup period. You can't take your money within 3 months or 6 months. It's typically a 1 year, and before you can take a redemption. You also have, depending on the fund, sometimes you may actually have to cover a due diligence cost. And some hedge fund in New York asked for $50,000 if you wanted to perform due diligence on their track record, because it takes the resources and of course the hedge fund managers understand that it takes their time, takes their auditors time to perform those. So who are the investors in the hedge funds? It's notable that 2/3 of those are actually institutions. So I think generally there's a perception that only the high net worth individuals invest in hedge funds. In fact, 75% of investors are institutions. Some of the sovereign wealth funds invest into hedge funds, endowments and university endowments. Other institutional investors, corporations, and many, many others. So at this point of time, high net worth individuals comprise only 25% of investors in the hedge fund. Some of the strategies, the hedge fund definition is so all-encompassing. It's been changing, and many funds that call themselves a hedge fund don't hold up to the traditional definition of hedge funds. They deploy a plethora of different currencies, and you can see all of them here. And it's typical that once one strategy stops working, they switch to another one. So I talked about 220 rule. This is just for you to understand in simple terms. What does it mean when you invest into the hedge fund? So, for example, as an investor, you hand out $100. 2% is the management fee. So take that out. You're left with $98. The hedge fund will invest your money into various markets, derivatives, bonds, commodities. Let's say they made, at the end of the period, $110, you have to pay 20% performance fee to the actual fund manager, and so you end up with $108. So geography, this is interesting. United States has domiciles about 30% of all the hedge funds globally, closely followed by Cayman Islands. In Europe, Luxembourg and Ireland are in fact the most popular jurisdictions. They also have special companies that allow you to easily form the hedge funds compared to, for example, U.S., where if you form a hedge fund in the U.S. and you file for certain exemptions, so you don't have to be reporting your performance and things like that to the U.S. regulator. You're actually bound by marketing limitations. You can't solicit investors by actively marketing the fund to them. In Luxembourg, once you obtain the license and registration, you can actually solicit investors. In Switzerland, it's not mentioned here as a popular jurisdiction. You have to get the permission from the banking association, which is essentially a banking license, but once you do, you can solicit any investor, including retail, into the hedge fund. So this is just another way laid out on the geographical maps, geographical map of all the hedge funds, and you can see that in terms of the AUM, U.S. controls over 66%. Asia has been a growing frontier for hedge fund investments. You have Japan, Singapore, and Hong Kong, and a lot of U.S. funds in the recent years actually establishing branch offices in Asia, because as we all know, China and other Asian economies are growing, and it's estimated that within 5 years, depending on the trade war outcome, the Asian economies will outgrow the U.S. In terms of the output, and so more and more U.S. hedge fund managers move to Asian countries and establish their offices there. And so that's what I was talking about when I said that only 4% of hedge funds control more than 500 million in assets. Of course, probably all of them. You hear their market commentary, and you hear the big wins and the big losses from all of these hedge funds. So the top earning hedge fund managers at this point of time, it's Renaissance Technologies, and this is a quantitative hedge fund. The people I talked about when I said deploy PhDs and developing all sorts of algorithms, closely followed by Ray Dalio of Bridgewater Associates, and I'm sure you're all familiar with those guys. So some interesting facts about the hedge funds that I came up during my research. The average life of a hedge fund is 11 years, which is, I think, is decent compared to the life of a FX broker, for example. There's a less than 20% chance of surviving the first 6 years for a hedge fund. And I already mentioned the FX concept, and John Taylor. It was one of the largest currency hedge funds where the primary focus was investing in currencies. It had at the top point, it controlled 14 billion in AUM. So this is compared to retail trading, and I think. Surprisingly enough, I found out when I was pulling this that Bank of International Settlement is actually using Finance Magnets, a company that organized this event, and benchmarking the retail volume. Although it seems like Finance Magnets overestimates a little bit, what Bank of International Settlements reports. But you can see again that hedge funds are. 94% of trading is happening out of UK and the US. However, there's been, as I mentioned, the growing influence of Asia, Hong Kong, Japan, and Singapore. All right, so hedge fund performance. Okay, so don't expect that I'll give you the exact numbers here, just to set your expectation, because again, because of the secrecy, there are various indices that track the hedge fund performance. However, there are things like survivorship bias, where if they are about to go out of business, they don't report their numbers, and not everyone is willing to report because it comes at a certain cost. So those are just some of the publicly available numbers that I was able to find, this is Hedge Fund Research Institute, and they're tracking the currency index. I think, again, like they have 1 year, 3 year, 5 year, and 10 year returns, and annualized returns, down below here. So for example, 10-year annualized return and in 10 years is 1.03%. And you think for yourself, I think, there's a lot of kind of myth that hedge funds are making a lot of money. Well, it depends, right? Some of them do strike the gold, and some are kind of just averaging or actually lose money. And so, again, this is another, Citi Parker index that tracks, I think, about 14 currency trading strategies. And so, it says right here, I think I took it from the Bloomberg article, that, 2019 is not a good start. I mean, mainly, I think, you probably heard that a lot today walking on the expo floor, that everyone is suffering from low volatilities, and low volatility, and hedge funds are no exception. And industry challenges. So what are the challenges of the industry? The industry has actually transformed and evolved tremendously post-2008 and post-Swiss franc crisis of 2015. The performance, hasn't been amazing. You can see that right here. Again, it has to do with volatility. A lot of things that the FX concept done was, swing trading, was carry trade. Those type of trading, that type of trading is kind of gone, and it doesn't work anymore. And so that's kind of the reason why FX concept, for example, failed, because they couldn't adapt to the change in market conditions, and it's extremely challenging in a low volatility environment to produce the same returns. So performance is definitely an issue for the industry. The second one is Prime Brokerage. Post 2015 crisis with the Swiss government removing the pegging of the Swiss franc, a lot of Prime Brokerages pulled out of the industry. And I say Prime Brokerage, it's Tier 1 Prime Brokers, it's the banks, it's UBS, it's Citi, and others. The Tier 1 Prime Broker, they pulled out of the industry, and the fees increased for most of the remaining participants. And so it became harder than ever to, first of all, get access to the FXDB for a smaller hedge fund, and it became even more expensive to deploy. Lack of volatility, as I mentioned, has been a challenge. You also see here the graph on the left-hand side with fund liquidations versus fund launches, and you can see that there's been less funds launched in 2018 than before, and there's been more fund liquidations. In fact, there's plenty of information online that investors are pulling their money out from hedge funds and trying to deploy it elsewhere where returns are greater and more diversified. So when I was talking about performance, I mean, not all the time hedge funds are able to beat S&P 500, right, which is the benchmark. The lower the volatility is, the tougher it is to make those returns. So how to start a hedge fund? Again, this is just a high level. The prerequisites is obviously, generally, who starts a hedge fund is an ex-trader, naturally. Someone who's been trading the markets, who understands the markets, who traded the market at a bank or at another hedge fund, at some point understands that he can do it on his own and make even probably better returns to the customers and be more flexible. So first thing you need to do is to build a track record. The second thing you need to do is get that track record audited. You need to register to gain credibility. Get some sort of a license, go to Cayman or go to Luxembourg. You have a higher probability of investors signing up with you if you have legitimate setup. Put in your own capital. This is something that hedge funds, the managers, has done all along. They always put the skin in the game, and they start with managing their own money, building the track record, and then soliciting investment from other participants. Finding the right partner is essential and crucial, especially in FX industry, which is over the counter and very fragmented. You need to find a partner that you can scale and grow the business with. So this is how the typical organization of the hedge fund looks like. So you have investors, those are called limited partners. Then you have a general partner, someone who actually establishes the fund. And sometimes you have board of directors. This is more for larger funds. You also have investment advisors and investment managers, prime broker, executing brokers. I mean, all of those things may apply or may not apply depending on the size of the fund. You'll obviously also have auditors and administrators, and in recent years, administration costs went up significantly for the hedge funds. And we talked about performance fees going down, administration costs are going up, so you need to make a greater return to compensate for that. You of course have legal advisors and custodians that hold the assets. This is something that is typical for U.S. Hedge funds because you set up U.S. investors are putting their money in what's called U.S. feeder fund. And then master fund is typically established in the Cayman because using the U.S. structure you can take overseas investors, and also for tax purposes and for all other reasons there's this master fund typically set up in the Cayman for the U.S. hedge funds, and so non-U.S. and tax exempt investors go through the offshore feeder fund, and of course there's an investment manager involved. What became popular in certain jurisdictions, like in the Cayman, for example, there is a special organization known as SPC, a segregated portfolio company. So instead of you going and doing by yourself the entire setup, establishing the feeder fund, the master fund, and all of that, you can actually tap into some established infrastructure. So a segregated portfolio company may be offering what's known a sub fund, SP Fund 1, 2, 3. And you have your own banking, you have it completely separate. The investor funds are not commingled, but you obviously tap into economies of scale by using the same already established framework with investment manager, administrators, auditors, legal advisors that allows you to keep the costs of running the hedge funds down. All right, so those are the typical costs. Again, obtained from the public sources. They may tremendously differ depending on where you are. Who do you use as your legal advisor? Who do you use to establish the fund? Who do you use to administer? But there is a significant difference between going the traditional way, establishing the master feeder and the offshore feeder funds, versus the SPC, what I just talked about, where you tap into economies of scale by using already established legal and audited framework of the master company. So this is a courtesy of Athena. This is a fund administrator that some of our clients work with, based in the Cayman Islands. And this is what they quote for establishing an SPC sub-fund. All right. Oh, so this is an interesting one. So how long or how much assets under management it takes you to break even? Here's the average numbers quoted in different people and different sources. So depending on who you talk to, whether or not, if you're able to keep your costs down and you you outsource all the administration and legal, you may be breaking down at 1 million AUM. But generally it's between 1 and 6. Oh, sorry, it's actually the reverse. That's when you do the presentation at 4 a.m. So for the SPC, it's actually a segregated portfolio companies. It's 1 to 6 million AUM. Why? Because you can keep the cost down, and for the traditional structures, it's more like 20 because you obviously ramp up a lot of costs in the legal and initial setup and things like that. And this is actually something that the research I've done for the previous presentation of mine when I was talking about the exit strategies and multiples for different businesses, financial investment businesses. And it's interesting to point out that when you look at the asset management, and this is all pertaining to FX, the multiples are much higher than the brokerage business or financial software business, for example. All right, so how do you scale currency hedge fund? As I mentioned, due to the fragmented nature of the business, you need to have a right partner that can have your back when you scale the business. And this is another challenge that a lot of hedge funds face, which is when they aggregate, when they accumulate a lot of money, more than $500 million assets under management, there's such a thing known as a law of diminishing returns. The more money you have, the harder it is to produce the same return. It's more relevant in FX than in any other market, especially if you're talking about the spot FX. And so here, the challenge number one is sourcing the liquidity and sourcing the right liquidity. As I mentioned, less and less people, especially if you're a startup fund, have access to tier 1 prime broker. And reasons why is because of the audit requirement, the cash requirements, leverage is much lower, and all those other things. Onboarding process is 3 to 4 months is just to get to get the PB, and then another 6 months to get the technology in place to aggregate and things like that. So if you use Prime, like advanced markets, for example, you're able to significantly reduce the time to market, but also have high leverage, and you don't need to have $10 million in your own capital in order to get started. So choose wisely. And this is an example of advanced markets, which is the prime of prime of our market depth. Here you have the liquidity providers disclosed, and for the hedge fund manager that manages $250 million and needs to execute larger clips, You can't use the retail liquidity that is ubiquitous, in the OTC market. You really need to find a partner that is able to execute large clips and is able to get your trade done without the rejects and without the requotes. Okay, that is it. Thank you so much.